Welcome to our webinar today. This is a Winning in Retirement's classroom session brought to you by Akers Financial Group. I'm Brian Akers, president and founder of Akers Financial Group, and we thank you for listening, watching, viewing, whatever you're doing today. We do thank you very much for coming. Now, this is a live show, but it's going to be available in recording on our website, akersfinancial.com, throughout the future for as long as we can, right? Now on the bottom of the screen, right down here, there's a chat button. Hit that button. You can talk to one of our staff as we're monitoring the webinar. We can answer your questions and really get information to you as you need it. We've invited Jeff Stemler from AMS, a Senior Vice President of Advanced Planning when it comes to insurance, to speak with us today. So him and I are going to be doing the talk. But what I want to do before we get started is tell you about our amazing blanket that Kim Haight picked out for us. This blanket is a throw. It's a very nice, cozy blanket. The first time you view at one of our webinars, you are eligible for a blanket. If there's some type of family fight and where you can't share the blanket and you need a second one, please ask for a second one and see if Kim is nice enough to send it to you. When we run out, we run out. So I'm not sure when that's going to be. Hopefully not too soon. We do have a couple of boxes left. So it was a good deal and a great thing for you. And a thank you for listening and watching our webinar. Of course, you guys can use our website at akersfinancial.com. Akersfinancial.com is a great place for you to go to get information about our company and about everything that we're doing. So when we're really looking at the webinar itself, I want you to think about the website itself, akersfinancial.com. So what I'm going to be doing is bringing it up real quick here. And what I want to do is show you exactly what I mean by it being very helpful. So let me share the screen with you. Here we go. It's all right. So I'm sharing the screen, and what I'm doing is showing you our Akers Financial website. You've already been to our webinar tab, and you can see all of our other webinars we've done in the past, which are still on there. You can still access them. And over here to the right is our radio tab. Under radio, if you click the radio tab, what happens is this. You actually get to see our Winning in Retirement about being on Saturday mornings from at 11 a.m. on 105.7 The Fan. Also, you can listen to the radio shows and then download the podcasts. All real good place, good information. Also, under this website, under resources, is an incredible thing that a lot of people don't know about. If you click this resource button, you can have different topics, and when you pick a topic, let's use investment, and you go into this a little bit deeper. There's more videos that are on our website at akersfinancial.com, and these are always available on our site. And we also have calculators under resource. So if you look at all the way down here under tools, you can see calculators. Calculators help us calculate things from systematic withdrawals, refinancing mortgages, life estates, how to do net worth, all kinds of incredible tools are available at Akers Financial Group. It's a great website. You guys ought to get to know it. Of course, everybody knows about the account access, which gets you to our e-money. So that's just something I wanted to show you before we get started today. But we have a great show for you, and we look forward to that. And enjoy our talk today by Jeff Stemler. Welcome to the Akers Financial Group Winning in Retirement classroom session. Today's classroom session is called The 5 Most Common Long-Term Care Mistakes. And today we brought a special guest, and that is Jeff Stemler from AMS. He's a Senior Vice President of Advanced Planning. Jeff and I have been working together for 19 years now in designing long-term care solutions for my clients. Jeff is a very experienced and extremely knowledgeable person, and we invite him to our webinar today, and we look forward to what he has to say for us. And the way we're going to do this webinar is Jeff and I will be on the screen, and I'll be the color commentator, and Jeff will be with the expert giving the talk. So how you doing there, Jeff?
Just fine, and yes, it's hard to imagine. It's been 19 years already.
Yeah,
but
absolutely.
It's been fun.
2002, so that was a while ago, right after the 9/11. That really changed my career to be able to get to know more people in advanced planning and the fixed annuities and things that provide guarantees. And that's something that I've been able to learn a lot from you over those times. So today's talk, it's one of your expertise is to be able to provide the answers in this most needed topic about long-term care mistakes and how to solve them. So Jeff, are you ready to give our talk today?
You bet. So let me get us all on the screen and we will be ready to go.
All right. So what we're doing is just bringing the share of the webinar up and then we'll be live. Hopefully everybody can see it okay. If you want to make any comments during the active live seminar, you can hit chat button and we'll be chatting along with you and watching this video when we do go live. All right, Jeff Stemler.
All righty. Well, the first mistake that we find people make when it comes to long-term care is we've spent our whole working life looking forward and planning for retirement. So we look to build up a nest egg, and that's where our focus is. The problem is when we finally get to the age of retirement, then we've got other issues, but most of us really haven't spent much time on it. When people start thinking of risk, they're normally thinking of their portfolio risk, which is the taxes, losses due to the market, things of this nature. So what ends up happening is we basically have a blind spot. And the thing that's important to know is that the blind spot is centered around death and extended care, or you may know it as long-term care. And while the taxes, the inflation, the potential losses are like holes in our bucket, a death or extended care is like the bottom falling out. So we've got to be conscious of this, and that's the first mistake, like I said, is the not looking for the exposure, and that's our blind spot. And so the 800-pound gorilla is the catastrophic cost of long-term care. And the key here is these numbers are very important: 70, 97, 30, and 100. 70% of us will have a need for long-term care. Now, I actually believe these numbers are low because people are living longer. And the problem is they're living longer, but it doesn't mean that they can function fully. So long-term care comes in more and more, certainly as we get older, because even if you're not sick, we become frail. But what we also know is that 97% of the population does not have long-term care. And I can understand that because the traditional long-term care that we've known that started back in the 70s was constructed very much like auto insurance. You paid a premium. If you didn't have a claim, the money was gone. The other side of this, just like auto insurance, you may not have ever had a claim. You never had your car stolen, yet your auto rates went up. Why? Because your neighbors did. Well, that's the exact same thing with the standard long-term care and the traditional long-term care. And another reason why people haven't done this is 30% will not need care. And men are particularly good at rationalizing that they're going to be in that 30% and the other 70 are going to happen to somebody else. And so the 100 stands for one thing. If you're part of the 97 that does not have any long-term care, then you are self-insuring 100%. Any comments there, Brian?
Oh yeah, when there's a long-term care talk with clients, what we try to begin with is having a family plan, understanding that there is this blind spot, this possible worst-case scenario in our future. The numbers you just went over are incredible to think about, that 70% of people will have an event that they need to be able to finance when it comes to their medical. There are also 97% of the people aren't prepared for it with an insurance policy. And what we try to do at Akers Financial Group is do financial planning to figure out exactly what the need is when something occurs like this. Our concern is that people need to be prepared and have a plan of how they're going to provide care or how their own care is going to be provided for as we head to the future. So this first mistake, when I saw that bucket with holes in it, I was thinking about cows and milking into a bucket. And whenever there's holes in a bucket, you cry over spilt milk. The spilt milk is money that's planned for the future, is then used completely for care rather than a legacy or some other dream that you might have set. All right, that was my thoughts.
Yeah, no, that's exactly it. And another reason why people have not purchased long-term care is they're afraid of the cost. And that makes sense because standard, like I say, traditional long-term care is priced like auto insurance. And when they have claims, the price goes up. There was one carrier several years ago that realized they underpriced their product and rose their premiums by 80%. But where are you going to find the money to do this? And the good news is the policies now are structured so that the premiums are locked down and guaranteed. You do not have to worry about future price increases. So what I tell people is most of us have just in case money. This is the money for an emergency. And so the point here is that you've probably already got the money sitting in a money market or a savings account, and it's barely earning anything, but it is liquid. Well, these policies today are constructed that you can buy a rider that is a return of premium rider. So you could feel free to put the money into a product, and if you change your mind or have an emergency other than long-term care, you can cash out the policy for what you put into it. So that's mistake number two, is thinking we don't have the money. Now, one thing I do know is Brian and his team are experts at helping you uncover, money and putting it into a productive use. So Brian, you want to just comment a little bit on that?
We believe strongly that your money needs purpose. The purpose money will then give you the risk tolerance and also exactly how to invest it. When we set aside a rainy day fund or a massive emergency fund to provide for all these worst case scenarios, we do need to look at other alternatives with that money to fulfill this exact need. Because the ideas that we're going to cover today with long-term care insurance is the fact that we can take this amount of money you have set aside and multiply it for certain uses. It is something we must look after. If we just set aside something like a year's worth of expense, that might not be enough for a true long-term care emergency that can last 22 months and longer on average. So make sure you're prepared when it comes to all this.
Yep, and the third mistake that we find is people are unaware that when they're thinking long-term care, they're just thinking of the actual policy itself. But in fact, there's an actual paperwork that needs to be completed. And the first one of those is that there is a financial agent that needs to be appointed. This is somebody who can take financial action on your behalf if you're incapacitated with assets that are not in a trust. Now, if the assets are in a trust, the trustee will make those decisions. But for everything else, for example, years ago, my aunt became incapacitated. My mother went down there to help her out and went to the bank to cash some checks and things of that nature. And they would not allow her because she didn't have that health care directive. So we were able to get my aunt to sign it, and she signed the form, and my mother then became a financial agent for handling her money. But there's another agent that needs to be appointed, and that's a healthcare agent. And that's the person who actually makes the medical decisions with the doctors if you are incapacitated. Now, this can be your spouse, this could be the trustee, but by the way, be sure you pick them wisely, because they really do have control over your health care, and you want to make sure they're somebody that has your best interests at heart. And then the final paperwork is a living will. And this is where end-of-life decisions are pre-made by you right now. So such as, don't do anything heroic, don't resuscitate, all of those kind of decisions. And by the way, that controls a lot of what the healthcare agent can do. So those three documents are incredibly, incredibly important. And I know that, Brian, you and your team have been very diligent on working with clients to get those done.
Absolutely. A very important part of working with clients when it comes to estate planning and long-term care planning is making sure you have the right documents. We actually had a webinar last fall on estate planning and these exact documents, brought to you by some local attorneys that we had. So we want to recommend that you guys go to our webinar at akersfinancialgroup.com, and on that website you can see that information. So understanding these documents, getting them in place, we need to do them as if something might go wrong tomorrow, not put it off to the future when we have to do it in case of an emergency. We've seen some situations where people have put it off to where it was too late to get the actual documents they needed, which then triggered a court that would have to be involved. We don't want it to go that way for you.
Yep. Yeah, and again, it is very, very, very important that these things are first created and then also reviewed as time goes by, because maybe your wishes have changed. All right. Well, the fourth mistake is that this is assuming all LTC insurance products are the same. And here's what I can tell you is, first, the products today are incredibly flexible. You can buy a lot of options on them. A lot of these sound similar when you're talking to somebody about the various companies and policies, but they are all different. Each carrier interprets or provides these benefits different than the other guys. And that's a real reason why you need to come in and see Brian and his associates, because they have access to all of these long-term care contracts, and they can help you wade through it. But let me just give you some idea of what I'm talking about. So I was mentioning that you can get your premium back. In other words, there's a rider, that return of premium rider. Well, some companies, it's 100% of what you put in. Others, it's 70% or 50%. And some will pay for refund all the premium. Others will return the premium for the base policy, but riders, you don't. Then it comes to waiting periods. Some have 90 days. You've got to be qualified for long-term care and wait 90 days before the benefits begin. Others, the day you become incapacitated, you are instantly, the coverage starts and you are starting to get paid. Another really important thing is, does the policy pay for informal care? In informal care, that's your spouse taking care of you, it's your children taking care of you. They're actually going to get paid for doing that. Other companies say no, it has to be a certified healthcare professional, and that's all we're going to pay. And then another really important thing is this a cash indemnity contract, or is this a reimbursement contract? And the cash indemnity is pretty straightforward. It just simply says, you signed up for $3,000 a month. If you qualify, here's a check for $3,000. On reimbursement, you may have signed up for $3,000 a month. But if you only needed $1,000, that's what they're going to reimburse you. Now, the good news is that $2,000 that you didn't use stays in the policy and just keeps on going. Brian, your thoughts on the various carriers and how you consult or counsel your clients?
Yeah, I guess it all begins with do you already have a policy? Many times people will come with an older policy that's more a healthcare, long-term care, and you might have seen all the rising costs. And so we see what they have. Most people don't have long-term care policies, but we sort of look there. And then we look at the concepts of insurability. We look at companies and policy designs. But what happens is many people want to put it off, to make it a future decision rather than a decision that needs to be made as we're getting ready to retire. We need to make these decisions while we're healthy because policies are more affordable and they can produce and provide more benefit the younger we are and the more time we can let them sort of grow to be able to provide the benefits we need. So not all policies are the same, but certain policies are designed for the exact situation that you might need. We use the word your financial fingerprint. That means understanding exactly who you are, so then we can figure out what policy, what company fits you exactly. And what we do is we actually give Jeff a call. We talk about the case and we design with him and his staff exactly the right policy for our clients. And then through that process, we put money aside and then we let that grow until that day comes when it's needed. Hopefully that's far in the future, but we got to be ready for any worst case scenario.
Oh, you mentioned just then setting the money aside, and I mentioned earlier about the just in case money, but there are other sources that are readily available. You may already have an existing life insurance policy that can be actually turned in and the cash value in there used to pay this premium. Another popular thing is you've got a 401k or an IRA. It's paying out required minimum distributions. You don't need that money, but you've got to take it. We can go ahead and actually put a long-term care annuity into the IRA or 401k, and it then through the RMDs funds the policies. And you can also have an old annuity. There's an annuity version of this. So if you still need long-term care but are not healthy, you can put the money into the annuities. All right, so we covered 4 of the mistakes so far. The blind spot, obviously, now we're thinking about it, so hopefully we've taken that away. And, you know, we found the money and we understand about the long-term care policies. But here is probably the biggest mistake that I've run across, and that is when we're talking long-term care or extended care, it's not about you. And by that I mean you are going to be taken care of, whether it's by your wife or your kids or Medicaid or whatever, you're going to actually be taken care of. The problem is this, is that extended care or LTC is not a place or a condition. It's not when you go to the nursing home. It's not if you have dementia. It's not even being able to take care of yourself. What it really is a catastrophic event for the caregiver. And so, great. So extended care is a life-changing event that can have devastating emotional and physical consequences to your wife, to your children, and your ability to keep the financial promises during retirement. And I can tell you from firsthand experience, this is exactly correct, that this is a life-changing event, and part of the reason you want to buy long-term care and also the documents and have a plan is to take the pressure off of them. But those of us who have given care, this might look a bit familiar. And when I talk to the clients, I say, when you are a caregiver, it's very much like Groundhog Day. Your schedule is set by the person you're taking care of. So yesterday, 5:30, I woke up. At 6, I took Dad out of bed and to the bathroom. At 7, made the breakfast. 7:30, put him in his chair and turned on the TV. At noon, made lunch. 12:30, back in the chair, back on the TV. 6, there's dinner. And at 6:30, back to the chair. And finally at 9 o'clock, put Dad to bed. My mother-in-law had Parkinson's. And for the first 2 years of her disease, my sister-in-law, my wife, and myself were the caregivers. So every third day, we knew exactly what to expect. But if you're a sole caregiver, this is what yesterday looked like. This is what today is going to look like. And this is what tomorrow is going to look like. So the real key here is your life does not end when you need extended care. The life is, they know it, the caregiver, that ends for them. And the other thing is, those that love you have no choice but to put aside their lives to make sure you are safe. And this really becomes an amazing phenomenon, because whether you're working, whether you're a stay-at-home mom, whatever, everything changes when you become that caregiver. And one thing that most people don't even think about is providing care to make your caregiver, may cause your caregiver to be as chronically ill as you are. An acquaintance of mine, his grandmother weighed 90 pounds, and yet she was taking care of her husband. In my case, my aunt, she was diagnosed with leukemia. We asked how long would she'd be with us, and they said, oh, it's slow moving. It could be several years. Right after we had that discussion, her husband, my uncle, became incapacitated, and they lived in Maryland, and a 2-story house. And she would go up the stairs, down the stairs, up the stairs, down the stairs, providing for him. And about 3 months later, he passed away. He passed away on the 1st of the month. She passed away on the 30th of the same month. Literally, taking care of him brought her to an early death. And here's another thing. People are saying, well, who's going to take care of me? And 9 times out of 10, it'll be the spouse. But if the spouse is not capable or no longer alive, it's going to fall down on the children. And as a matter of fact, there's a pattern. And the pattern goes like this. The child who's going to be anointed the caregiver is usually the one that's closest to them geographically. If it's a boy and a girl, the daughter is going to get picked. Now, the others are not going to just leave everything alone. They're going to be involved in this, but unfortunately, the way it normally sounds is one will say, sis, why aren't you doing more for mom? And the other one's going to say, sis, why are we spending all this money on mom? The bottom line is the caregiver is right in the middle, and there's nothing they can do about it. So remember, when you buy long-term care insurance, it's not for you. It's for your caregiver so that their life can continue, and give them their life back by allowing them to manage your care, not provide it. Brian?
Yeah, long-term care is one of the hardest situations families can go through. What we found at Akers Financial Group is we have to have family meetings. We bring everybody in. We usually bring a team of advisors in, such as the attorney, sometimes the accountant, and we have the financial advisor. And we work out a plan on how to provide the needed service and to see what they could afford. Now, for those that we've planned way far ahead and provided the funding, it's a matter of turning it on, which is our preferred answer. But in some cases, we get clients after they're no longer insurable. And so we have to try to do a version of funding with the idea of how to protect assets and move money to make each and every bill and then provide the level of care that's needed. Most of us want to stay home for our long-term care, and that provides an added expense. That's the most expensive option. But to be able to do that, we need to have insurance or something in place to pay those bills. So as we're talking about the idea of long-term care and that decision, the earlier we can think about this, the better we can plan ahead. But throughout our area, there are places that are retirement communities which provide all levels of care. So one alternative to insurance is a change of living, where you're going to be, and having a facility that you have your place that you're living, and then when you get sick, you can move to assisted living and then move to nursing care. And then basically you're putting all your assets on the line for that. So there's lots of choices when it comes to how we're going to provide. Planning on how to handle this is one of the most important things. And then that leads to actually implementing the plan and looking at different insurance options. And that's what Jeff's going to lead us through.
Right. And I'll give you an example here of what you're going to need or how a policy works. But the one question that we ask people, how much of your retirement assets are set aside for extended care? And they go, no, 100,000 or 200,000 or something like that. Well, I would submit to you that without a plan, everything you have is on the line to pay for the long-term care. And as Brian said before, the average now is around $90 a day or $90,000 a year for nursing home. So it doesn't take very long to eat up a lot of money. Just by the way, in Alaska, because it's so sparsely populated and all that, it's almost $200. $200,000 a year. So these things really can mount up. Now, I said we have a new version of long-term care, and that is asset-based long-term care. That means where you take $100,000, $200,000, and you can make a single payment, or you can pay it over 10 or 20 years or even a lifetime. But the point is, it is based on a life insurance chassis, which means that the price is fixed. The actuaries know exactly how many people are going to die at a certain age. They just don't know who. And so you can enter one of these contracts with a great deal of confidence, knowing that the premiums aren't going to change on you. But again, why would we do this? Because once the money is put inside there, the principal is protected. It is not exposed to market risk or anything of that nature. Second thing is, all the benefits coming out for LTC are income tax free. Since this is a life insurance product, the money you put in there actually will grow. And in most cases, it's 2 to 3 times what you would be getting for a CD or definitely for a savings account. And since they're life insurance based, it's a tax-free death benefit. So these are just 4 of the reasons that people really want to get long-term care. And by the way, let's just show you the example. I talked about some leverage. Well, here's it right in front of you. Self-funding. You've got the money. You're able to say, I've got 100,000 there. The issue is, if you do need long-term care, that 100,000 is buying 100,000 of LTC benefits. After that, you're on to your next batch of assets. We had a client and he said, oh, I've got plenty of money, so, it's all earmarked, no problem. I said, all right, but let me just show you the power of the leverage here. And so we have the same 100,000, and we found the need for them was, it's a husband and wife, they were both 65. They both needed long-term care and wanted it. So we found them a contract that would provide coverage for both of them on one policy, and each one of them would receive $3,230 per month, and that'd be double for two of them, and that comes out to $77,575 annually. And it just is interesting that a semi-private room in Maryland averages around 75,000. So this was how they made the decision of how much did they want to, how much did they need. And let's just assume that somehow they've got the policy and all of a sudden needed long-term care, and they both lived age 90. Well, that policy that they put $100,000 into would have paid almost $2 million in long-term care benefits. So this is the reason. This is exactly why we look for the correct policies and the correct amounts, because 100,000 that can pay off 2 million is significant leverage. Brian?
Right. Well, this kind of policy, I know you're showing here that if it paid out for that long, the idea is this: they put in $100, it's paying 77,000 annually. So in less than a year and a half, all the money comes back in benefit down the road. And then you'd also talked about return of premiums, allowing for the ability to pull money back out if we were needing at that in a situation like that. The idea here is to have money with purpose, money set aside that we then can use with the goal of providing long-term care insurance. Sometimes when we're using every penny we have for income, we then have no money for worst case scenarios. So we need to have a balance. Sometimes this means we got to save a little bit more during our working years, so we have this set aside. Also might mean a big decision on, do I keep my health care funded life insurance or long-term care insurance, the one that keeps going up all the time, or should I put money into this? And now this version here is showing a lump sum premium, but there is a lot of flexibility, like Jeff said earlier, about funding these kind of policies. The cases that we have used over the years for clients are taking an earmarked money that's set aside for a purpose, and designing a plan that would fit them best. Now, this kind of policy works in many ways, right, Jeff?
Yes. And are you talking about the various riders and things of the nature? Because
yeah, the lifetime riders, the policy
right.
is based on a guaranteed life insurance contract, so they're not going to hammer us with extra surprises down the road.
Right, and so again, part of these options that you're able to buy, we talked about the return of premium rider, but these policies base policies run from 1 to normally 5 years. And if you're afraid that that's not enough, you can buy an endorsement that extends the coverage from another year to 7 years for most companies. And one particular company, and the only one that offers this, is a lifetime guarantee benefit. And that's what you're looking at right here. And literally, if they live beyond 90, this thing just keeps on paying. And this is incredible. And they even have an inflation option so that the amount of coverage goes up as the years go by. So again, I think when you're confronted with this, if you sit back and look at this and really study it, you can see that the leverage is incredible. But the most important thing is going back to what we said before. This policy is not for you. You're going to be taken care of. What this is to give the caregiver enough money to provide the care through an outside source. They manage the care, but don't provide the care.
All right, so these policies, what happens, it starts with planning, where we look at the need for you and your family, and then we discover about insurability to see if this is a viable option. They do turn people down who have basically problems that would occur that could cause you to be disabled in a near term, and the company could deny people. So designing these while healthy and while younger is very important. The longer we wait, the less we can get the benefit of the policies. So the sooner we look into the planning, it should be part of your retirement plan is designing this kind of plan. Do you recommend to always start earlier than later, Jeff?
Yes, yes. This is truly one of those cases where the longer you wait, the higher the premiums. That makes sense because you're getting older. But the other thing is it becomes very much like playing Russian roulette. I'm talking about insurability. Unfortunately, as we get older, things change and they don't change for the better. So again, the sooner you can get involved with this, the better off you are. And again, like I say, there are so many ways to fund this. Again, if you have a 401k, if you've got an IRA, and you're taking required minimum distributions, those can be used in this product. If you have existing life insurance, you can actually surrender it and put the cash value into these without any taxation. If you have existing annuities, the same thing. The annuities can go into the annuity version of this. And by the way, if you are uninsurable, you can still do planning because regular annuities, deferred annuities that don't require any medical underwriting, you just hand them money and they issue an annuity. Many of them have a spatial rider that says, if you are admitted to a nursing home, whatever our payment is to you, we're going to double that for a length of time or until the money is gone. And then even if the money's gone, the worst that happens is you drop back down to your regular payout and continue on. But that's, we see the flexibility. But again, the purpose of this is to take care of the caregiver.
Exactly right. All right, so today we just covered the basics. There's the need, there's the mistakes, things that you need to think about. And this is an example of how life insurance, long-term care can work for us when we're doing our planning. It all starts with the beginning of discovering the need and then figuring out how to fund this. Any final thoughts, Jeff?
No, there's always thoughts, but the real thing here is if you haven't experienced this personally, it's hard kind of to put yourself in that position. Like I said, I know it from firsthand experience. Interestingly, just last month, a couple that I had spoken to 5 years ago about the long-term care, and they said, yeah, that sounds good, but no. And he called me and said, we need this now. It turns out they're now taking care of his in-laws.
Yeah.
And he said, I don't want my kids ever to be in a position that we've been put in. And so that is, again, the reason for all of this is to take care of the caregivers also.
Absolutely. When someone becomes a caregiver, they see the need and the massive need for cash to be able to pay these bills. One of the most expensive times in a long-term care situation is when you have a healthy spouse and an unhealthy spouse. You got to make a decision on how to fund both of their lives as we look for care in the home or care at a facility. All very expensive and could lead to where we need to find up to $12,000 a month or more on the funding of this. All right, so Jeff, Do you know that all of our people that watch our webinar today get an amazing blanket, an Acres Financial blanket to stay warm for all of our webinars? So if you're a new listener or a new viewer of our webinars, make sure you chat, make sure we got your information. But the first time you sign up for one of our webinars, we give you one of our Acres throws or our blankets, a nice blanket to be able to sit there and watch our webinars. We're going to send one out to Jeff's wife, Jen, so she can stay warm at their home. But you're usually warm anyway, probably. But Jeff, we thank you very much for being on our show, on our talk today. We thank everyone that's been listening as we go through this today. If you have any questions, you give us a call at 410-692-9870. This Winning in Retirement classroom session is about long-term care, but we cover so much more. Be sure to stay tuned to our radio shows on Saturday mornings at 11 a.m. on 105.7 The Fan. And of course, go to our website, acresfinancial.com. Acresfinancial.com, we have our webinar tab, and of course our radio tab where you can see our past radio shows and hear topics like this. Jeff was on one of our past radio shows. You can hear the same type of webinar done for that radio show. But thanks again, Jeff, and thank you for everyone for listening, and enjoy the rest of your day.